Hey everybody, welcome back to Tim Travels. It's Terry, your host. So I'm coming to you from Hubbard, Ohio, and just right on the border with Pennsylvania, right off of I-80. So I'm up to 1,491 subscribers. So I came upon a book called 1491. It was actually published back in 2005. But after reading some reviews about it, it's by a gentleman whose last name is Mann, M-A-N-N. It was pretty interesting because he did a very rigorous scientific study of demographics, population, culture, and the environment in the year before Columbus supposedly found America, right? And what he concluded in that book, and I'm not saying don't get it and read it because I think it'd be a great body of information. And it, like I said, it was well received, well reviewed. But he basically concluded that there were a lot more indigenous people in the Americas than previously thought in the 15th century. That they came in more ways than just like a Bering Sea land bridge, and that there were several waves of immigration to the continent. He concluded that their cultures were a lot more sophisticated than we earlier believed, and in terms of the environment, that they often altered their environment to meet their needs, often with fire. Like they would burn things down, burn woods down to maybe plant crops, stuff like that. So it's interesting that it's about the time before Columbus came. And like I've pointed out, a lot of the history that's available in just generally is about white Westerners. And, our understanding of history especially of indigenous peoples, is really lacking because they didn't write books that are read, by scholars. And, so research like this is important, but it also points up the fact that there's this what we know about history is the tip of the iceberg of what really happened. Like when I look up stuff about even stuff that happened 500 years ago, which in the grand scheme of things is nothing, it's mostly about rich people, nobles, the clergy, right? People that had power. So you got to take that with a grain of salt, or not a grain of salt, but you just got to say, hey, this is a little bit of what we know, right? That's why people still get PhDs in history, because there's so much more to learn. I mean, I look at like the Battle of Gettysburg, the scholarship continues on that, to this day. I mean, it's not like there haven't been hundreds of books written about that one battle that was, we'll call it 4 days in 1863. And that wasn't that long ago. And we're still learning more, like there were people that were alive during my parents' lives, certainly, that were at that battle. And yet we just don't know that much about it. I mean, but look at recent events, like look at 9/11. Like millions of people witnessed that thing, but we're still learning about it. So anyway, I give you that little perspective on history. So before we get into today's subject, which is really getting back to this factoring thing and credit and how big companies manipulate people, and some ideas for establishing credit in your own business, even if you're just going to have like one truck, or you're going to open a bakery or whatever it is, right? I'm going to share some ideas with you. But real quick, getting back to 1491. So in 1491, Copernicus, who is the guy that is basically credited with establishing that the sun is the center of the universe and that all the planets rotate around it. Notwithstanding that there were people before him that posited the same things, it's generally believed Copernicus came to his research independently. But here's a picture of him. So in 1491, Copernicus actually entered the University of Krakow. For those of you not familiar, Krakow is in Poland, and it is the hometown of Pope John Paul II. He was the Bishop of Krakow. But also born in 1491, Azai Sukamasa. He was a Japanese samurai and a warlord, probably serving, I don't know, maybe the 6th or 7th shogun. I'd have to look that up because Japanese history is not my strong suit. And then also born in 1491, the Philippine king Lapu-Lapu. So let's talk about. I'm gonna talk about a few things, but let's talk about factoring first. You know, I had some comments, and I'm just looking at my notes because I kind of got a list of things I wanted to mention. So people were talking about, I was talking about factoring and how this company, Core Capital, I think they were called, they shut down, and it's causing like a lot of brain damage for people. And I had some people that commented and said, hey, I've been factoring for years, but I feel like the 3% that I pay is worth it because then it helps my cash flow. I can get my money sooner, and I don't, it's part of my business model almost, right? And my response to that was, that's not a horrible answer, right? I get it. But when you say 3%, you got to be clear about what you're talking about. And what I said is, supposing for a moment that somebody, so let's say you had a trip that was worth $1,000. They owe you $1,000. And you are willing to take $970 for that trip. But the invoice on that trip is paid to the factoring company 30 days after you get your payment. Well, yeah, you paid 3% of that trip. But you can't just look at this like it's 3%, because you have to look at it like it's a cost, right? It's a cost of your money. Now, it sounds weird to say there's a cost to money, but you have to also look at money like any other commodity, right? You might go to the grocery store and pay $2 for a loaf of bread, okay? That's the cost of a loaf of bread at a supermarket. But you might also go to a farmer's market and somebody has a loaf of bread that they want $2 for, and you're like, hey, look, I don't have $2, but I'll give you a pint of blueberries for that loaf of bread. Well, then the cost isn't $2, it's the pint of blueberries, right? And there's what is called a bargain for exchange. In other words, you value a pint of blueberries some amount less than you value the loaf of bread. And if they do the deal, they value a pint of blueberries some bit more, I don't know how much more, than the loaf of bread. Same thing with the $2, right? If the grocery store says, we want $2 for this loaf of bread, what it means is that $2 is worth more to them than having possession of that loaf of bread. And conversely, you might have paid $2.01, right? So the $2 is worth less to you than the loaf of bread. Okay, that's the bargain for exchange. So getting back to money, right? If I say, hey, I have $970 that I'll give to you, okay? But in return, you have to give me $1,000, okay? Now we call that interest, but it's the cost of money. In other words, getting $970 today is more important than getting $1,000 30 days from now, okay? That's kind of like we talk about the present value money. However, that 3% to get the money 30 days earlier actually is 36% on an annualized basis. And that's how we do things, right? We do annual percentage rate. You know, how much interest do you make on an annualized basis? Okay? That's a thing, right? And we're in business not for a month or a week, but we're in business theoretically in perpetuity, right? That's unless you say the business is going to end on a date certain. So I said to this guy who said, oh, the 3%, I said, you know, dude, that's 36% on an annualized basis. And so my question is, would you borrow, if you went to a bank and you said, hey, I need this money, and they said it's going to be 36% interest annually, would you borrow that money? And if the answer is yes, well then it better be life or death, because 36%, man, that interest adds up quickly. Or you know, you're not understanding the import of what you're doing. And this guy said he had been doing this since 1984. So 38 years, if my math is right, 38 years he's been borrowing money at around 36% annual interest. And I said, that makes no sense. And he said, well, I don't want to put it on credit cards and I don't have other sources of capital. And my response to that is, you might be better off putting it on credit cards, because maybe you could get a credit card, get a cash advance, live off the credit card if you need to, at 18% interest or 12% or whatever you can get a credit card for. Right? Because when you don't, the easiest way that people get ripped off is when they don't even understand they're being ripped off. You know, I've made great deals in my life and I've made bad deals, okay? And I know the difference. You know, when I was, you know, a 20-year-old sailor and I was paying, I think my first car that I bought in 1984 actually, you know, I think I paid like, I don't know, some stupid, like 23% interest, right? Now, interest rates were significantly higher then, because even in 86, when I bought my first house, my interest rate on the house was like 10.5%, right? No one in their right mind would buy a house nowadays, even with the Fed recently raising interest rates, like 10.5%. If my kids, they'd be like, no, we can't do that, right? But that was the norm. Like, my roommate and I didn't have horrible credit. We were just kind of like, yeah, that's a thing, right? That was not subprime. That was just kind of middle of the road interest rate for a house. So you know, and I started thinking about all the times he's done this, right? And the tens of thousands of dollars that he has earned and never seen, right? And oh by the way, if he was doing it right, he still ended up paying taxes on that money, right? Like, so that money never even hit his hand and he still was taxed on it, okay? And by the way, that interest would not, those fees, whatever you want to call them on that factoring, would not have been tax deductible, okay? It would be a business expense, and depending on how everything's accounted for, but it's not tax deductible. So, what are the alternatives to doing factoring? Well, certainly one of them, like I mentioned, is to get a better source of credit, right? The factoring thing is easy, right? Because once they get you in their program, it's really easy to just say, oh, send the invoice to these guys, and you know, and they're told how much the invoice and they advance this money, right? But it comes at a huge cost, right? There's a reason. They're not your friend. They're not running a charity. They're making huge money off you, okay? If I give you $970 today and in 30 days you give me $1,000, that's a good deal for me. Okay, that's a good deal for me. It's way better than I could get in the markets or in, you know, a savings account or something. Okay, so that's the first thing. But so credit cards could be an alternative, but the key here is getting to the point where you're not needing factoring, where you have enough cash built up. And so what I would say is factoring is a drug, right? It's an economic drug. You got to get off the drug, right? You got to go through treatment. You got to wean yourself off the drug and then stay away from the drug. And what does it take to do that? Hard work, right? And so what I would do if I were this person is I can't just cold turkey it, because that probably means I'm going to have to go like a month without any income, okay? So what I would do is every single time I got a payment, I would put a set portion of it away. I don't care if you got to eat beans and rice and beans until this is over, but and drink only water from the tap. That's what you got to do. Now, obviously, you got to pay your other bills. You got to put fuel in the truck, change the oil, put tires on it, whatever to keep your business moving. But beans and rice and beans. And I think that comes from Dave Ramsey, actually. I'm not a huge adherent of his, but I like the beans and I like beans and rice. But you got, you know, like I've told my kids, you got to suffer to be successful sometimes, right? Success does not come easy. Like Ashton Kutcher said in the Teen Choice Awards a few years ago, success looks a lot like hard work. To get off this drug of factoring, you're gonna have to pay the piper. That means putting money away, not using it, and building up that nest egg, building up that pile of cash that is there to backstop you when people are slow to pay. That's the way you get off the crack, okay? That's the way you get off the trucker economic meth, all right? Build up the nest egg. Come up with a plan. Maybe it's going to take 6 months. Maybe it's going to take a year. You know, maybe you're going to have to wait to put new tires, giant tires on your pickup truck that's bigger than you need, okay? And burns too much damn fuel. Maybe you're going to have to cut back somewhere. But the alternative is to continue to be in this cycle that is it's eating up mind-boggling amounts of cash that you're never going to see again. If you ever want to retire, you got to get away from that, right? You got to get back to, I spend what I have and no more, right? Because that's what's happening here. You're spending money you don't have, right? Somebody gives you money that's not yours until they give it to you. You're spending money to get that, right? Remember, the fees, the interest, that's the cost of that pile of cash. And, you know, you got to get out of that cycle. Now, maybe you go to a different factoring company that has better terms for starters, right? You get better at this, but you got to get off of it, because even if you never go into that death spiral. Although I got to be candid, I was thinking, okay, you do this for 40 years, you know, what's your last month in trucking look like? What does it look like? You're like, okay, well, I factored, you know, a dozen times a year for the past 20, 30, 40 years. What's my last month look like? Do I factor it and get nothing? Or do I just, you know, kind of like crawl into retirement? I mean, I don't have an answer for that, okay? But But the biggest thing that trips people up is not understanding where their money goes and how much they're pissing away because of convenience or just wanting something immediately, etc. You know, when I worked at MetLife, and I don't know if I ever talked about this guy, but when I was a financial advisor, and we had this saying that it's not how much you make, it's how much you keep, okay? And really how much you earn on what you keep. And I had this client that, including his permanent life insurance products that he had and other stuff, I probably had about $1 million cash, like easily accessible. $1 million under management for this guy and his wife. And the wife had never worked. He was totally blue collar. He had been like a phone company man. God drives around a little van and climbs up on the poles and hooks up a telephone in your house. That's all he did for a living. They raised like 4 kids. Their house was paid off. They had 2 older Pontiacs that were still operating, that were completely paid off. I don't think the guy had really any debt. And he had like $1 million with me, right? Not rocket science, right? He kept what he made. He made decent money, right? He was a blue collar guy back when being blue collar was, you know, could be lucrative. Although I will say being blue collar in today's society can be lucrative depending on what you do. So anyway, you gotta understand where's the money going. You gotta read stuff. So let's talk about, I'm going to talk about credit generally and some of the things to look for. So there's business credit, there's personal credit. Now for a lot of us, if we're like a one-man band, then our personal credit rating is basically what our businesses is. But somebody asked me, well, how do you get to having like a business credit rating that maybe isn't necessarily tied to your personal credit? And that's kind of tough, but one of the things that I mentioned was getting what is called the Dun & Bradstreet number. And Dun & Bradstreet is a big credit rating agency, but they also do a lot of other stuff, and they own stuff in the financial markets and stuff. But you can go to their website, DNB, like Dun Bradstreet, and Dun is spelled D-U-N. Bradstreet, just like it sounds, Brad Street. Go to Dun & Bradstreet and say, hey, I'm interested in getting a number, and here's my business, they're going to ask for information. But the Dun & Bradstreet number, once you get it, can be used to access business credit. The other option that I don't think, I've almost never heard truckers mention, is a small business administration loan. Now, how SBA loans work is you go through a lot of rigmarole, including needing to have a business plan to get an application put together for the Small Business Administration. Then once you are approved, you can go to any commercial bank and they will work with you based on a guarantee that the SBA is making. Okay, so it's just like if you have a VA mortgage, right? SBA's involved guaranteeing the mortgage. So, or guaranteeing, payments and stuff like that. And that's part of why banks will do an SBA loan, right? If you're a minority or you have a woman-owned business, they may qualify for other programs, okay? That's one way to do it. The other way is to just be operating. A lot of times these institutions want to see operating history. So if you've only had a CDL for 3 months and you're like, hey, I want to buy a truck, know that you're considered a high risk. What does high risk mean? It means they charge you more for the money that you want to buy from them, okay? In other words, you pay more interest, you pay more fees if you qualify at all. How much assets do you have? If you already own a trailer and a truck and you're trading a truck in and you want to get a newer truck, well, you already have assets as long as they're not encumbered, meaning they're not liened, right? You can use that as collateral, okay? Banks like stuff they can repo. So those are some of the ways that businesses can build credit. But also, there's a few things that you need to understand about, business credit and stuff like that. So one of the things that I always put in lending documents was what is called a cross default clause. And this also comes into play with credit cards, like personal credit cards. And what does a cross default clause mean? Well, it can mean a couple of things. One is, let's say that you have a credit card let's say you have 2 credit cards with a bank. Okay, you have 2 different credit cards account for whatever reason. And then you go to them and you get, you have an SBA loan and you get a business line of credit. Okay, well, if there's a cross default clause on the documents that you've signed, what it means is that if you make your personal credit card payment late, they could declare you on your SBA loan or your business line of credit, they can declare you in default because you had a default on one account and that counts for all of them. So one default is like defaulting on any of them or all of them. There are also default clauses, cross default clauses, that if you default on any obligation, it can trigger a default. Now, why does that matter? Well, oftentimes there are default interest rates, or they could call the note. So like, let's say you borrowed $100,000 on an SBA loan, maybe there's a cross default clause. You owe $60,000 on that, you default on a credit card for whatever reason, right? Your ex overspends on it, you didn't know about it. They can call that note, meaning they could say, hey, in a week, you got to pay us the $60,000 because you defaulted due to the cross default clause. And if you don't, we're repoing your truck. Okay? So that's one kind of clause to look out for. Another thing that people are often presented is what is called a personal guarantee. Now, if you sign a document where you're the applicant personally, you're the applicant, you're not going to also do a personal guarantee because you're already guaranteeing it personally, right? What I'm talking about is a document that's separate, that puts an obligation on you personally for, say, a loan that the company has, your company. Even though it might just be you, it's 2 different things, right? It's 2 different people. Like Mitt Romney said, corporations are people. And he was mocked for that, but it's actually true, right? It's a legal fiction, but it's the idea that, before corporate law was really kind of put together in the forms we see it today, corporations were just these big kind of, pile of gases in the atmosphere, right? They weren't, you couldn't sue a corporation because it wasn't anything. It was just a place people went and worked. And so what happened is, when they kind of reframed corporate law, it became possible to sue a corporation or for a corporation to be sued. And it took on a legal personage, if you will, right? Because before that, only people could be sued. And, our corporate law kind of advanced. So anyway, let's just say that, you get caught up in you get a loan and you do a personal guarantee. What these personal guarantees are going to say is that If there's a default on the underlying instrument, whether it's a line of credit, credit card, loan, if there's a default, the lender does not have to take action against the defaulting party. Okay? In other words, the maker on a note, right? The person, the entity borrowing. And they can go directly to you and they can sue you for that money and make you pay. They don't have to first try to collect from the company. A lot of people sign personal guarantees, and this is especially important if you are a partner with somebody, you know, and let's say that you're like, yeah, we're going to buy some trucks. We're going to have our small fleet. And somebody said, and they say, okay, well, we need personal guarantees. Well, let's say that the other person quits or you quit. Well, that doesn't void that personal guarantee. The guarantee is still in place. So if you quit a company where you personally guaranteed something and then the person left behind doesn't pay the bill, guess what? They can come knocking on your door and go, hey, you signed this guarantee, give us our money. And you're like, I don't even work there anymore. They'll be like, we don't care. This doesn't say you had to work there. It just says you guarantee that that note's going to be paid. Okay? So be very careful about personal guarantees. Now, if you're just a single operator, kind of solo, sole proprietor, single member LLC, you're gonna have to personally guarantee stuff, or you're gonna be on the contract anyway. So it's not really gonna matter. But anyway, those are a couple of things to look out for. But let me tell you how on like credit card stuff people use it. And just for reference, I have represented, to name like household names, Bank of America, Citibank, I've represented Chrysler Motor Credit, and and some other smaller banks. I used to represent the bank. They're out of Illinois or out of Nebraska. They were the ones that had the NRA branded credit cards, but I can't remember the name of the bank. But there were other big banks that I never represented. Like I never represented Chase or Capital One or anything. So I'm going to tell you there's a bank that, and one of my favorite people in Hollywood is Jennifer Garner. And anyway, Jennifer Garner does advertisements for this one bank. And one of the things I used to see with them, because I would see like packages for loss mitigation when somebody had a mortgage that was in default. That bank that Jennifer Garner works for, and she's a lovely person. I'm sure she doesn't really know much about this. What they would do is, let's say that somebody has a credit card with them, and they have a $2,000 limit. Let's say that that person would like to get more credit, or even that bank decides they can have more credit. They won't increase the credit line on that card to say $4,000. No, what they'll do is they'll issue you another credit card with a $2,000 limit. And then maybe, because I've seen this, that you deserve more credit, so they'll issue your credit card with a $3,000 limit on it. And then there'll be another one with a $4,000 limit. So now you have 4 credit cards, right? And you have two, that's 4 plus 4 is 8 plus 3 is $11,000 worth of credit with this one bank. And you love Jennifer Garner, and you love Samuel L. Jackson and Bradley Cooper, and they're all great people. And so you got 4 accounts with this company. But here's the thing. If you read those credit card agreements, what happens is first of all, they all have cross default clauses, right? But they also have all sorts of triggers, right? So let's say that, you know, because now you're juggling payments on 4 different accounts, right? Let's say that you mistakenly pay twice on one account and forget one account and don't make the monthly payment. Now you are in default on that card you didn't make the payment on, because you have an obligation to make the payment every month. And because you went into default on that card, even the card that you made 2 payments on, you're in default on that, and you're in default on the other 2. And once you go in default, then there's a default interest rate that kicks in. And even though you only missed 1 payment, you got a good payment history, now you've missed 1 payment, and that credit card, so now you get a missed payment fee. And you know, this, I've seen people go from being just able to maintain to all of a sudden the freaking wheels coming off. Like when you see a plane just like tumbling down a runway, just crap flying everywhere, that's what happens, right? They're maintaining course and speed, and then all of a sudden everything's going all over because of one mistake. One mistake. Not even really financial irresponsibility, not even that they couldn't make the payment, just they forgot to make it, or they made it on the wrong account. But that's what banks often do. And then because, and here's the other trick, let's say that all of those let's say that the card that you didn't make the payment on was at, let's say you owe, it's a $2,000 limit. You don't make the payment, right? So then the second you don't make the payment, right, the next billing cycle starts, and you have the penalties for not making the payment. So now you owe $2,050. Well, guess what? You're over your credit limit. So there's a charge for that. Okay? And you could see how this could quickly, and then so the next month, when you were making like $70 a month payments, the next month, just to get that thing current. So all the other credit cards, it's a higher payment because the interest rate went up. And it went up on this, but now you got all these additional charges. So instead of making a $70 payment, you now have to make a $240 payment because you owe over limit fees, missed payment fees, extra interest, all of that stuff. That's how people get in trouble with credit. Is it's not that they are irresponsible, it's that they don't understand the system and they make one mistake, and it can really snowball. Also, you go without working for a couple of weeks, you know, it doesn't take much to land yourself in hot water. And unfortunately, having good credit is necessary. And you know, your credit rating affects your auto insurance rates, which would also affect your commercial vehicle insurance rates. There's just so many things that you gotta look out for. But my best advice, and you know, and trust me, I've had high interest stuff. I've done stupid things with credit cards and had to dig myself out. Or actually, my wife digs us out. I just make the money and then she manages it, and she's way better than I've ever been at it. And maybe, you know, and if you're in a marriage and one person's better at it, just let them do it. I'm not saying just toss it to them, you know, but work together, right? Work together as a team. But it's really important that you get a handle on this, okay? That you have some savings, and that you don't like the guy that started factoring in 1984. He probably didn't go into business thinking, hey, on every dime I make, you know, I'm going to take a 36% haircut so I can get the money when I really need it, so my family doesn't run out of groceries. You know, he didn't start out saying that, But once he got on that crack, right? Once he got on that, economic meth, that's how it started to go. And people, like I mentioned it yesterday, people that are spending money, okay, on credit to buy stuff that's going in their bellies. I mean, I'm not talking about restaurants, I'm talking about grocery stores, right? That, you do what you need to do. And I'm not saying let your kids go hungry, right? You can't do that. But you gotta just recognize what's happening in real time. You can't wait, because look, if you gotta do that today to buy groceries, you're gonna have to do it in a month. But in a month, you're not gonna have that kind of credit limit, okay? And it's gonna impact your credit rating. And, so do what you need to do to put food on the table, but also do what you need to do to stop having to, put food on the table with a credit card that's 18% interest. And I know, I'm not saying this without recognizing what's going on, okay? But in a high inflationary environment, right, you're saying, oh, I got to pay more for a steak, okay? Well, now if the steak is whatever percent higher than you used to pay, but then you're paying interest on top of it, is the steak really that delicious? Is it really worth that much money? Or could you be better off, buying rice and beans and rice, right? Because you don't know where it's going to end. And look, I've seen people with lots and lots of credit card debt. I certainly have been one of them in the past, and it's you really gotta think about where it's going to end, and what I mean is how you're going to get out of it, right? The longer it goes, it's like losing weight, right? It's like any bad habit. The longer it goes without attention, the harder it's going to be. So I know I probably engendered more questions than I answered, and I really do want to provide information and give people some ammunition to deal with, and so. If you find yourself in that kind of pickle, like the saying says, when you find yourself in a hole, quit digging. And sometimes, you just got to say, no, I can't go out with my friends. No, I'm not going to see that movie. No, I'm not going out to dinner. What am I doing? I'm going to stay home and eat beans and rice and, watch free TV. Watch Tim Travel's videos on my cell phone, so anyway, I appreciate everybody. I hope this was helpful, and if you got other questions, I'll answer them. Certainly, I try to answer everybody's questions, and but I felt like maybe doing something like this would be of value to other people, besides just the commenters. So thanks to the commenters for bringing up some of this stuff that I just maybe repeated today. And I know I didn't cover everything, but hopefully that's a little bit of a start and get you thinking. So talk to you soon. Be careful out there. Bye.